Solana, one of the most sought-after projects in the crypto universe, has captured the interest of not only many retail investors, but also institutional investors since its inception. Today, we will answer the question of whether it is worth investing in Solana and how its price might evolve in the near future, based on various scenarios. But before we delve into the technical analysis, let's take a look at some fundamental data, which we can conveniently find on CoinMarketCap. At the end of the video, I will share my personal price forecast. Please note that my forecasts do not replace professional investment advice. I am not a financial advisor or an investment professional. The information provided in this video is for general informational purposes only and should not be considered as financial or investment advice. At the time of recording, Solana ranks 9th on CoinMarketCap with a price of $23. The 24-hour trading volume is an impressive $300 million, indicating a high level of trading activity and significant interest in Solana. The circulation supply of 405 million out of the total, 554 million coins, confirms that currently 73% of all Solanas are in circulation. Now let's take a look at the chart and identify important price levels. We will use various analysis methods to identify potential entry zones. According to the Dow Theory, an uptrend is characterized by higher highs and higher lows. Whenever an old high is broken upwards, a brief correction phase follows before the next higher high can be formed. This process continues until the uptrend is interrupted, which usually occurs at the point where the last higher low was formed. In this case, right here. As we can see, the correction of this impulse movement began after the trend break in November 2022 and has been ongoing until today. This downward movement could theoretically go as far down as 80%, and it is only considered complete when this bearish structure transforms into a bullish one. That is, when we see the first higher high. It's important to note that correction movements can also correct themselves. Considering the numerous indications of an impending slowdown in the U.S. economy due to the restrictive monetary policy initiated by the U.S. Federal Reserve, it wouldn't be surprising to witness another low in Solana before the price hopefully reaches new astronomical heights in the next bull run phase. Now let's turn to the Elliott wave theory. According to this theory, the price moves in an upward movement in 3 impulse waves and 2 correction waves in between. The current wave could be wave 1, followed by wave 2, which might possibly end somewhere around here, before wave 3, typically the longest of all 5 waves, catapults the price significantly above the old high. By using the volume profile, we observed that the highest volume was traded in the zone around $2. The profile gives us a valuable clue about where institutional interest was highest in the past. Typically, these so-called high-volume nodes, also known as the value area, act as magnetic fields. The buyers responsible for this massive increase will likely defend this zone in the future. So we expect the market makers to try to push the price close enough to this high-volume node to find the best possible entry. Now let's talk about the Fibonacci tool. As mentioned earlier, the price moves in waves, which means that an impulse wave is followed by a correction wave, followed by a new upward impulse movement, and so on. To determine the end of a retracement during a pullback, we use the Fibonacci tool. The most important percentage levels at which the correction waves end are usually 38.2%, 50%, 61.8%, 70.5%, and 79%. The so-called golden pocket around 61.8% receives the most attention, as the correction movement usually ends there. However, using the Fibonacci tool alone is not enough. It is recommended to analyze the chart with additional tools to identify or even refute agreements. In fact, the 2 levels below, around 70% to 80%, can also be reached. The smart money concept is an analysis method that, in my opinion, is truly insightful and reveals the institutional trading strategy. Those who trade based on this approach recognize the supply and demand levels of the big boys, based on the so-called accumulation and distribution phases. This theory states that large entities usually place their buy and sell orders in areas where the markets are manipulated, at double tops or double bottoms. When the so-called institutional candle removes liquidity at a double bottom, and the price immediately reacts bullishly, we know that someone with enough power was at work, capable of moving the market. As retail traders who usually operate with just a few satoshis in the market, we base our actions on what the market makers do and try to swim with the flow to catch some fish. So, why are these last sell to buy candles, or last buy to sell candles, so interesting? When institutional traders, as illustrated in this example, remove liquidity and immediately push the price in the opposite direction, they remain in a drawdown with their sell position until the price returns to that level. This pullback is essential for institutions because they must first close their sell position before moving the price in the desired direction, in this case, upwards. Now that the sentiment is bullish and retail traders are flooding social media with to-the-moon slogans and rocket emojis, market makers use this movement to gradually get rid of their long positions, usually without attracting much attention in several small sell orders. So where are the most crucial levels where the institutions need to close their books in Solana? Right here. The last sell to buy or order block, as we've seen in the volume profile, had the highest trading activity, suggesting that it wasn't the average Joe with his 20 Solanas, but rather one or more smart entities at work. And that's exactly where we want to position ourselves. Our long-term price target is around $2,000. In conclusion, every trading approach, no matter which one you follow, can provide valuable information. There's no single indicator or trading concept. You should trust your personal strategy. If it works, then go for it. Don't get confused. Based on the examples presented and applied by me, we found many agreements. However, we must not forget that no one can predict the future with certainty. Our decisions are made based on 99% probability calculations, which are also only based on past performance. Past performance does not indicate future results. Keep that in mind. The good news is that the probability, and thus the success rate, is relatively high if you know what you're doing. And that's it. Happy trading!